This line that you see here, moving up and down, shows us one of the most important positioning metrics for Bitcoin. It tracks how large speculators, like hedge funds, quant funds, and commodity trading advisors are positioned on Bitcoin based on data from the CFTC Commitment of Traders report. These players often control massive positions using leverage, which amplifies both upside and downside moves. Right now, their exposure to Bitcoin has dropped to some of the lowest levels we've seen since 2022, and this could actually lead to a huge move on Bitcoin. One likely reason speculators are still underexposed right now is because they are concerned about a sharp pullback on Bitcoin. After all, Bitcoin is still considered a high volatility asset, and large speculators are very aware of that. Throughout this current bull run, we've already seen multiple corrections of 20%. As this chart shows, these players often hold highly leveraged positions, which makes them especially sensitive to sharp pullbacks. So the current underexposure we're seeing from them may be less about long-term conviction and more about short-term caution. But what stands out is how this cycle has actually been far less volatile than previous ones. In 2021, for example, Bitcoin experienced multiple 40% corrections. And during the 2017 bull run, 35% pullbacks were the norm. By contrast, the largest drawdown we've seen since 2023 is around 32%. So now, Bitcoin offers the potential for strong returns without the same kind of volatility we've seen in past cycles. And that combination becomes far more appealing to large players who manage billions in capital. We can see this by looking at this chart showing the impact of adding just a 5% Bitcoin allocation to a traditional 60-40 portfolio, measured over a 3-year time frame. The orange line here represents the baseline portfolio without Bitcoin, and the green area shows the additional return generated by that 5% Bitcoin exposure. What stands out is the consistency. Even at the low end, the added return has been around 2.65%. On average, it's been closer to 21%, and in some cases, it's gone as high as 48%. Now, of course, this is measured over a 3-year span, so results can still vary from year to year. But over time, Bitcoin has repeatedly shown that even a small allocation can significantly boost portfolio returns, and that outperformance becomes even more compelling when we add in the full portfolio stats. This table breaks down the performance of a traditional 60-40 portfolio compared to one with a small Bitcoin allocation. Even with just 5% Bitcoin, the annualized return, which tells us the average yearly return, jumps from 6.2% to 10.6%. Now, yes, adding Bitcoin does increase portfolio volatility slightly from 8.5% to around 9.7%, and it also raises the maximum drawdown for the portfolio from 22% to 25%, so basically by 3%. But that trade-off has historically been more than worth it, because the boost in return more than outweighs the small added volatility, and we can see that by looking at the cumulative returns, which shows the total gain over the entire period. Adding Bitcoin more than doubles this number from 97% to 210%. So this attractive risk-reward potential is a big reason why underexposed large speculators may be preparing to rotate back into Bitcoin. And one of the key reasons why that rotation could be starting now can be seen through this chart of the global M2 money supply, essentially a measure of global liquidity. It tracks the total money supply provided by 20 of the world's largest central banks. This is important because Bitcoin is a global asset, and its demand comes from institutions and individuals all over the world. So the entire world is a potential buyer of Bitcoin today. And recently, this metric has been expanded to new highs, indicating that there's now a record amount of liquidity in the system. Now, if we put the price of Bitcoin on top of this chart, the relationship becomes clear. While it's not a perfect one-to-one correlation, Bitcoin tends to generally move in the same direction as liquidity. And this relationship becomes even more clear when we look at this chart. It shows how often Bitcoin moves in the same direction as global liquidity. This concept is called directional alignment, and it simply tells us that when liquidity rises or falls, how often does the asset rise or fall in the same direction? This bar here represents Bitcoin's directional alignment with liquidity, which is at 83%. So in simple terms, that means Bitcoin moves in the same direction as global liquidity more than 8 out of 10 times. That's a very strong relationship, especially when we compare it to other major assets. The S&P 500, for example, comes in just behind Bitcoin at 81%. Gold is lower at 68%, and treasury bonds lag far behind at around 45%. So it's clear that Bitcoin is one of the most sensitive major assets when it comes to the direction of global liquidity. And with global liquidity increasing rapidly today, it's a strong tailwind for Bitcoin, suggesting that Bitcoin's general direction should likely be up in the next few months. So today's macro backdrop can force large speculators back into the market. And historically, moments like this have often marked important turning points for Bitcoin. For example, in November of 2022, large speculators were quite underexposed, and that coincided with a bottom on Bitcoin before the price rallied by 60% over the next 3 months. We also saw underexposure in January 2023, January 2024, and October 2024. And all three of these instances preceded an 80% move up on Bitcoin within the following 3 months. So, when large speculators are least exposed, like today, it tends to precede a big rally. And with today's exposure back to low levels, a similar 60 to 80% rally would put Bitcoin somewhere between $160,000 and $180,000 by October of 2025. Of course, like any other metric, this one isn't perfect either. In June of 2023, speculators were just as underexposed as today. But instead of a breakout, Bitcoin entered a 3-month period of consolidation, with nearly a 25% correction before an 80% move up. However, in our opinion, such an outcome today is quite unlikely. That's because global liquidity that we looked at earlier doesn't just help us understand Bitcoin's past moves, but it can also give us a clue about what might be coming next. When we take this chart of Bitcoin with global M2 money supply and shift forward the liquidity line by about 12 weeks, we can see that the two lines move together almost perfectly. So Bitcoin's price actually tends to follow the path of liquidity with a 3-month lag. This is a relationship we had also highlighted back in April of this year, when Bitcoin was still trading near $80,000, and it has kept us bullish on Bitcoin throughout this rally to $120,000. Now, if this pattern continues to hold, global liquidity is suggesting that Bitcoin could actually be on track for a move towards the $170,000 region by October of 2025, which would be in line with the most of the rallies we've seen when large speculators are as underexposed as today. Of course, no market moves in a straight line up. There can be short-term variations in both time and price. For example, Bitcoin did consolidate longer in May and June of this year than liquidity alone would have suggested. But with global liquidity rising and large speculators at the precipice of reallocating into Bitcoin, we think the odds favor more upside from here. That's why we still hold an active long position on Bitcoin on our website, with our most recent entry at $107,000. We've been taking our clients step by step through this crypto bull run, sharing our trade setups and strategy through 3 weekly premium videos. In just the past year, our crypto trades have delivered some incredible returns, including a 30% profit on Bitcoin and an 83% gain on Ethereum. We send out buy and sell alerts whenever we make any changes to our position. If you want to follow all our trades in real time, make sure to join us using the link below.